how to combine wave principle and divergence part 3. How to combine wave principle and divergence part 3. In this tutorial, I want to discuss with day traders and swing traders and Elliott wave traders how to filter out false divergences during the third Elliott wave. I recommend to traders to watch the full length of this video so they may understand how they can combine the wave principle and divergence trading. Very often, there are traders that use a divergence trading setup to profit in the financial markets. But most of the time, these traders make wrong decisions because they are not able to combine the wave principle and the divergence. If one is a divergence trader and one is able to combine the wave principle and the divergence trading, one is likely to make better divergence trading decisions. Alright? So, the divergences that appear during the third Elliott wave, the first thing you want to understand, promise me that you will never forget, is that these divergences are usually false divergences. There is only one divergence during the third Elliott wave that is, a temporary divergence. It takes place at the end of the third Elliott wave. So, at the end of the third Elliott wave, we see a divergence. That divergence is only a temporary divergence. So, if you have watched the first part of this video, you will already know what is a temporary divergence. So, I will not dwell on it, only to refer you to the first part of this video. So what are we looking for, my friend? We want to know, so we are trying to navigate through the market. We want to map, the charts. So we know that here we are. So if you haven't watched the second part, we know that the best bullish and bearish divergence will take place at the end of the second wave. So the purpose of trading the bullish and the bearish divergence at the end of the second wave is to catch the third Elliott wave, which is the best time to trade, whether one is day trading and swing trading or position trading. So we can enter the trade here to catch the third Elliott wave, or we can enter the trade here above the high of the first wave. Remember how we catch the third Elliott wave. We can enter the trade here, the risk is low here, but we can also be very patient and enter the trade above the high of the first wave, right here. Break above, retest, turn around. So I'm talking about a bullish trend here. In a downtrend, we will see break below, retest, turn around, below the low of the bearish first Elliott wave. But here we have a bullish first Elliott wave. We can enter the trade. We can catch the third Elliott wave at the end of the second wave or above the high of the first wave. So, usually, during the third Elliott wave, we will see the first false divergence. It will take place here when the price is on or near the high of the first wave. So, we see the second wave is completed, price start going up, price reaches this level. Now we see a divergence. Now remember, our trading style is based on combining the technical analysis and the fundamental. We are not using the technical alone. These are the old way of trading. Now that we have the smart money, the hedge fund, the big institution that are fundamental traders, one cannot ignore the fundamental analysis. So suppose, my friend, we are trading a stock XYZ, and XYZ is in the third Elliott wave, alright? So the price now, during the third Elliott wave, is at the point where it's in the zone of the high of the first wave. Now we see a bearish divergence because we're in an uptrend. If you were in a downtrend, we see a bullish divergence. So So the first thing that should come into our mind is that this is usually one of the useless divergence trading setup. But before we can quantify or filter out false divergence, we will check the fundamental. So if the stock XYZ has passed the Google acid test, the fundamentals are solid, the market environment is viable, and we see a divergence right here. When the third area will reach the high of the first wave, we can just laugh loudly and let other traders trade it. Okay? Or we can just ignore it and wait until the price breaks above the high of the first wave, retest and find the support, and then we just catch the third wave. Or reload it. If you already buy at the end of the second wave, you can buy for the second time right here. So the first place where a false diversion usually takes place is right here when the third area wave reaches the high of the first wave. But suppose that the stock, we are in the third area wave, suppose, my friends, suppose we are in the third area wave, price going now reaches the high of the first wave. But the fundamentals are poor. We are an uptrend, we check the fundamental, the stock has failed the Google acid test, the market environment is not that bullish, there are a lot of economy hanging on onto the market, and we see a bearish diversion here. We can trade it because the fundamentals are not supporting the technical, therefore the divergence that may appear here may be a valid divergence. And the price may go down, and we may wonder, what are we talking about? There is no third area wave, there is no third bullish area wave if the fundamentals are weak, and there is no third bearish wave if the fundamentals are bullish. Okay? You get it? So this is the first place where we are likely to see the first for a signal if the fundamentals are supporting the trend. The second place that we are likely to see another false divergence during the third area wave. Remember, talking about the wave genius at 24areawave.com, we can either use the magnitude of the first wave. I don't want to talk too much. This is the magnitude of the first wave. So the first wave went up from here to here. The magnitude is the height of the price progression. So as the price goes above the high of the first wave, we project the magnitude of the first wave to the upside. So there's a high chance that we may see another false divergence somewhere in this zone here. We can also use the length of the first wave. This is the length of the first wave, and we put it, it's not in the same direction, so we put it at the beginning of the third area wave. If I adjust it like this, so we may say somewhere here, when the third area wave achieves the same length like the first wave, either in magnitude or in length. That is another place where we are likely to see another false divergence. Talking about wave genius. Or you see the consolidation that usually takes place. Suppose we have a consolidation before the first wave, and we project that consolidation. So we can keep projecting the size of that consolidation to the upside. Okay? Wave genius. We project it. This horizontal channel, we will project its size many times. Suppose we project it many times, okay? 3 times will be somewhere near the top of the first wave, and we continue to project it. At one of these projected channels, so talking about the consolidation channel, we are projecting 1, 2, 3, 4, 5. Somewhere here, we are likely to see another false divergence. So pay attention to where the projected channel is ending during the third area wave, and if you see a divergence at one of these levels, be careful. It's likely to be a false divergence. In summary, false divergence regularly take place during the third Elliott wave, one should ignore the divergences that usually appear during the third Elliott wave. So, suppose you were trading, using divergent trading setup all your life, and you say to me that, George, the Elliott wave principle is just a mambo jumbo, and I don't want to know. Well, what I will say to you is that you are not the only person in the market. There are traders using all sorts of tools. So these are our competitors. It will make sense to know what are the tools that our competitors are using. Most importantly, to understand how they are using it. So, in case you are discounting what we are discussing here about the wave principle, I recommend to you to pay attention to what is going on in this messy market. A group of traders may make another group of traders lose, not because the other group is wrong, but it's because the other group, does not know how the first group is trading. So it makes sense to know a little bit about the Elliott wave theory. So during the third Elliott wave, if you are divergence traders, and you have scanned for stock, for commodity, for futures, and you have now a list of a divergence trading setup, check whether these divergences are taking place during the third Elliott wave. If they are likely to be forced divergence. In that case, you may not trade it. Or, if you decide to trade it, you need to be very, very careful. The only divergence that we can maybe pay attention to, which I will not pay attention to, is at the end of the third Elliott wave, and that divergence is a temporary divergence. Why is it temporary? Because very often, the third Elliott wave is the longest wave. If the third Elliott wave is the longest wave, it's not always the longest wave, but it should not be the shortest wave. This is one of the fundamental Elliott wave rules. So if the third Elliott wave is the longest wave, it's dynamic during the uptrend, it's bullish, strong, the fourth wave is usually very shallow. So at the end of the third Elliott wave, here it is, a temporary divergence. I don't want to trade it. I'll wait that the fourth wave is completed, and before I will catch the fifth wave instead. Bearish divergence, bullish divergences that appear during the third Elliott wave are useless divergence trading setup unless the fundamentals are supporting that divergence trading setup. One must always combine the Elliott wave principle, the technical analysis, with the fundamental. Going to Google Finance, check the financials, check the balance sheet, perform at least Google Asset test, check the economy news, and the market environments. This is the end of this video about how to combine wave principle and divergence during the third Elliott wave. In the fourth part of this series of video, I will be talking about how to combine wave principle and divergence, part 4. In that video, I will be talking about divergences that appear during the fourth Elliott wave. You want to know? And it's also powerful. If you like this video, please give us the thumbs up. If you dislike this video, I beg you to let me know and give us the thumbs down. Alright? And if you love this video, feel free to share it on Google+, on Twitter, and also on Facebook. If you love our video, it's time to subscribe. Hit the subscribe button so you may stay tuned and watch more tutorials like this. Thank you for watching, and we will speak to you very soon. We are the TSTW 24 traders.